due diligence and investment diligence in general has evolved even quite a bit since I've been in the seat, in the investor relations seat in 10 years. It's not an easy process. Allocators have many, many different funds to choose from when they make a decision to allocate to a hedge fund, a private credit strategy. It's really a lot of information that they have to synthesize. I think something that we have to think about as how this industry has evolved and become more institutional is that means it's no longer in the hands of a single individual. When we think back to the history of this industry, it was a lot of raising money from friends and family, folks that have watched you invest, perhaps spinning out from your own firm. They think that you're smart, can do a great job, give you some money to invest alongside your own money. And that certainly happens. But we've seen this shift where much of the new funds that have come in over the past decades, and this trend continues, is from pension funds, endowments and foundations, more institutional and structured family offices. And when it does come from private wealth, a lot of that also does go through different channels and gateholders, including private banking platforms and some of these RIA aggregators. We also have the investment consultants who have a whole business about choosing funds and being able to offer insight about whether that's a good fit for the particular strategy of an allocator. So we're in a space where there's an increasing amount of demand for information, not just performance. Of course, that's always going to be important. And nobody's going to make an investment unless the performance stream and the numbers are a good fit for their portfolio. It doesn't always mean just absolute returns, but what sort of diversification that return stream might offer to a portfolio, but also about the business, about the operations. There's a statistic out there that, a very large number of hedge fund failures come from the operations rather than the investment. So it's important that they're able to vet whether the fund has a proper infrastructure to stay in business over the long term and to be able to sustain the type of performance, to be able to retain the talent that leads to that performance. So as more and more information is required, more and more transparency is expected, it becomes more and more challenging to go through that process efficiently. And, that's changed the role of investor relations portfolio. I think there's a stereotype out there of folks in that position going out to the golf course or drinks and happy hours and dinners and wining and dining. And again, there still is social networking and, having good relationships and being a people person can be quite important, but it's also become a lot more technical because when allocators have data, they're going to ask a lot more technical questions. And the person in that role needs to be prepared to be able to talk about the strategy, talk about what goes into performance, again, lead through that operational review and really be a proxy for the portfolio manager. So the portfolio manager and the analyst team can do what they should be paid to do, which is to look after their portfolio. Of course, there's always going to be a point in time where the investor will likely want to have at least a conversation with the folks and the team managing the money. But the role of the investor relations person is really to be able to quarterback the whole process and make sure it's efficient. And, I always get surprised, but perhaps it's just human nature. So it shouldn't be surprising how much of it is just being organized and having good follow-up and being, a really proactive, yet not annoying, there's a fine line, manager of the situation so that the investor has everything that he or she needs, has it in a timely manner, has it accurately, has all the compliance records crossed off and can make their way through. There's a lot of technology now coming into play, right? It's with all of this information, it's not always the most secure or the most efficient way to send PDFs and emails back and forth. So you're seeing a greater adoption of things like virtual data rooms, automated diligence platforms, databases for directly sharing and inputting that information. However, we are an industry of relatively small businesses, so that has not quite replaced the human in the process. I think something also, though, that investment managers have to realize when thinking about this process is the time goes both ways. So they see how much time they and their team put into the diligence process, and it can be really frustrating when it lasts 6 to 18 months, which is a typical process. However, the allocator as well is investing a lot of time and money into the process because their team also needs to gather that data, has to analyze it, has to aggregate it. If they do decide that they want to go further, that's probably going to entail some on-site meetings that can change to a bit given COVID, but still the preference is if they are underwriting a new relationship, they're probably at some point in time they will want to see that office. So it's going to potentially involve travel, hours of research, follow-up. So it's an exercise that's not taken lightly from the allocator side as well. So I think that's why it's really important to really enter into this in good faith and be really efficient, really organized, really focused partners to make it through and get everyone the information they need in order to have a successful outcome.